All right, so let's have a look at possibles. Again, remember guys, before you place any trade, you have to fully understand all possible outcomes of it. Okay, and you invest your own money and you have to make your own decision. Okay, don't rely on my opinion or anyone else's opinion. Before you do this trade, you have to analyze this company one more time, okay, yourself, and make sure that I didn't miss anything. Okay, now we can look at 4 strategies. So first, it's long term. So if you're busy, you buy it and hold. And if you buy it around $19, $20, and then you can hold it until our hold range, which is 31 to 41 or above. If fundamentals improve, you might hold it higher. It might happen actually pretty quick, few months, because the retailers now improving and people are getting more excited about that. So it might push the price up, but it might slow down again, and maybe we'll have to wait a couple of years in order to achieve it. But that's up to 100% profit. Okay, no bank will give you such a return, and also it's nearly 3% dividends on the current price if you're buying it. So it's again pretty good return. Banks won't give you that type of money right now, and it's US dollars as well. Then we can do roll strategy, so buy and sell using technical analysis. And if we look at this, we already kind of look at the prices. So if you buy it here, you might sell it around 22 bucks. If it breaks through, so you might make it about 10% growth, maybe 10 to 20%, 15%. Or if it goes back to $90 and start moving in this kind of rolls, right? So it's like 19 to 20, you can make this $1, which is about 5%. Okay, also, but you have to pay attention to these levels. And if you use roll strategy, like if you're buying and selling, that's your strategy, use stop loss here. Or be ready if the share price drop down, let's say to $15, buy more, like, and become a value investor, long-term holder. Okay, but if you don't want to hold for a long time, always use stop losses. Okay, all right. The next one is BR strategy, where you buy and sell covered call. I'll show you now the slides, but it gives probably 1.6 to 2.8% max. Okay, and if we sell naked puts, it's about 1% to 2.9%. And if we buy and sell LIPS call option, that's up to 52% of profit. Okay, but here it's a risk higher. So let's have a look first. Selling covered calls. I chose strike price of $20. So it's the last price of shares last night was $90.75, and looked at $20 strike price. We can see that we can get 35 cents. It's 24 days until the expiration, so it's not a full month. So that's why I put 0.8, and it will give us 1.6% return. Right, so if the share stays below $20, okay, just for cash. If the share is exercised, so if the share price moves above $20, we get extra 25 cents because we bought at $90.75, sold at 20, so we make another 25 cents. It gives us 2.8% return. So which represents 25% or 42% return annually. If we keep doing it every time, like as soon as we close this position, we roll to another position, and we keep doing the same way with same type of level of profitability. Okay, so that's our annual return going to be. Now, the thing interesting here, like if we do this trade, we buy shares right now and then we sell call, our break-even price going to be $19.41. So which is higher than its current support around $19. So if Dory sees that, like Dory said, $19, so maybe it makes sense just instead of doing the strategy, just to wait a week, right, until it drops down to 19 bucks and then to buy it. Okay, in this case, you do only one trade and you buy it 40 cents cheaper. Okay, so patience sometimes is more important. And patience on both sides. When we are buying, we have to wait until it goes down. And patience on the way up when we want to sell it. For example, 2 days ago, 2 nights ago, I closed my buckle position because it jumped after earnings to $21, and then it starts sliding down, and I thought to $22 it jumped, and then it starts sliding down, and I thought, oh my goodness, I am going to sell it because it was going down and down. So I closed the position. On that night, it went even lower down. But bloody hell, last night it moved up nearly 4.5%. So it moved nearly $1 higher than I sold it. And you never know. You cannot be right. Okay, so never. So because sometimes market is completely crazy and unpredictable in the short term. Okay, that's why we just have to adjust our strategy in the long term. So, but the best way probably here to get at $90, and then the best way to roll it at $22 and sell it. But maybe it doesn't go to $90 anymore. Maybe it stops around $90.30. Okay, how can we profit from that one? Okay, what can we do, guys? Because if we wait until $19 and we keep a cash for that, if it never happens, we're going just to keep our money not working for us. Correct, Dory, use put. So the next strategy, we're going to use put. Now, but before I switch to put, now, like especially new guys, do you understand how it works here? But can you put pluses if everything is clear? Fantastic. Okay, let's do it. So put. So instead of buying shares, we can sell put. Now I put two strike prices. Specifically, I chose one $19 strike price because we distinguish that like it's support. Right? So let's have a look if we do it. So if we use strike price $90, we're going to get only 20 cents. You can see it. Even though the last it was 28 cents, so last trade was 28 cents. So it's somewhere between 20 and 30. You might bargain and you might get more, but I just chose, for example, 20 cents, which was at the after close price. If we get 20 cents, our profit is going to be 1%. For 0 points, it represents about 14% annual return. So what means if you decided to buy shares at $90, you're happy to buy shares at $90, and you say, okay, fine, it might never happen. So what I'm going to do, I'm going to sell this put. And if share drops below 90, I'm going to buy shares at $90. But if it doesn't happen, at least I collect 1% return. Okay, it's like 100% return on your money, at least 1%. And you're happy to buy that company at $90. So you sell puts only when you are happy to buy this company. You have to remember that. So, okay, that's one case. Okay, in this case, your break-even point would be $18.80, like plus commission. Okay, because 19 minus 20 would be 18.80. So you actually would buy it even lower, but it might never happen. Okay, and your return in this case would be 1%. Another option is to do $20 strike price. If you do it right now, you get about 60 cents, which is 2.9% return. Okay. And that gives you about 43% annual return. Okay, if the share price move above strike price, so if it stays above $20 price, okay, so that would be 2.9. So it's similar to maximum call profit, 2.8 here and 2.9 here. The difference is here is just because you do it only one trade. In here, you just sell put, you pay commission only once. Whereas here, you pay commission twice. You have to buy shares, and then you have to sell a call. That's why the difference in profit here, because in reality, it should be about the same. Okay. Now, do you understand, guys, what put options? So, and again, I want to repeat about selling naked puts. You sell naked puts only when you are happy to have this company for you. Now, this company is not that great for selling puts or selling calls. It's much better probably to make, with this specific company, just buying and selling shares, because you can make more return. You can make 15% just buying at 22 and selling at 20 and selling at like 23, for example, right? $3 profit. You can make more money rather than doing stuff like that. But this third strategy can give you the maximum return with a certain amount of risk, of course, here. So buying leap calls. So remember, usually we sell calls, but sometimes when the calls are low in volume, we might buy it. But if we buy it, we have to buy it for long term, because we know that the time start melting usually within last 3 months, and the fastest speed is during last month. So that's why we buy as long as possible. So if the company stays on the same level, the option price will not change for several months in future. And maybe otherwise, if you bought the call when it was undervalued, so with a low volatility, when the earnings coming up, the price of the call might increase just because of volatility. Okay, let's have a look. I chose here 3 strike prices. So if we buy call with a strike price of $18, we're going to pay $3.40. Now, I want to ask you who can calculate straight away what's the break-even price and what's the time value here. Who can tell me? Okay, 21.40, correct. And what's the time value? So how do we calculate time value? We take 3.40, right? So that's the premium which we did. And then we need to deduct the difference between our strike price, if it is in the money, and the current share price. So the current share price is $19.75. So the difference is $1.75. So from $3.40, we're going to deduct $1.75. Do you get it? 165, correct. So that's our time value. It means that we are paying $1.65. That's the real our payment for this specific option, because the rest we're just paying the difference. Okay, so we overpaying $1.65. Now, if we buy with strike price 20, what's the time value there? It's a tricky question, guys, but very easy. What's the time value? So we're paying $2.40. Correct, Jonas. $2.40. Correct, Gina. All the money, whatever we're paying, because it's out the money. So we don't have real difference there because the price is below $20. Whatever we pay, it's all time value. Okay. And what about $23 strike price? What's the time value here? Fantastic, guys. Yeah, great. $1.3. Correct. Okay, so that's what we are paying. Then we need to know, okay, fine, we paid this money. We're not going to keep, I hope you all understand, we're not going to keep this option until the end. We're going to sell it. Maybe we'll sell it in 2 months' time, maybe in 2 weeks' time, maybe in 3 days we're going to sell it. As soon as the option price, the share price moved up, the option price will move up as well. The question is, for how much? Okay, that's the question we should ask ourselves. So we distinguish that the share price might go to $22. Okay, that's what we looked already in our technical analysis, right? So we looked at that is going to go to somewhere here at $22. So if we buy it somewhere here, even at current levels, and then share price moves $2.25 up, and when we sell the call, okay. And let's have a look how it happens. I put a small table here, the way I calculate it. By the way, like, can you put that everyone understands what delta means? That I don't explain it again. So if you don't know, put minus. I forgot. Okay, I'll explain. Now, the delta shows us how much option premium will change in price on $1 move in share price. So if we see 0.7, it means that if the share price moves $1 up, it's going to increase 70 cents. If the share price goes $1 down, it's going to decrease 70 cents. Okay, so that's what we understand. So now, if we know that the share price, and actually it's valid only for the first dollar. After that, it's going to change. Now the question is for you guys, probably you already know. What do you think if the share price moves up to $90? What will happen with this delta? Is it going to be higher or going to be lower for the next dollar? From $90, would say from when it goes, at the moment the share price is $20 nearly. When it moves to $21, from 21 to 22, is it going to be higher or lower delta? Correct, Jonas. It's higher. So 70, it's medium. If it price moves up, the next $1 will give us higher return. It would be maybe 80. And the higher it goes, it will be coming closer to 1. You see here, it's 90 cents. So it's, and those in the same way. But right now, just for calculations, we understand that the time works against us. So that's why when I calculate, I don't go into these difficult calculations, because you can actually do that. You know, when the share price moves, how delta is changing, and then you can adjust it as well. So in my case, what I do here, delta 0.7. I know that my buying price, my exit price. Okay, so $2.25 here is different. I multiply it by delta. Okay, so I get the difference, how much the option premium has to improve. Then I added a premium which I paid, $3.4, and then I deduct the spread, because when we're selling it back, we're going to sell at a lower level. When we buy at a higher. So it's 20 cents here difference. So, and that's how I come up to $4.70. Do you understand, guys, or do you want me to show the calculation how it works and type it for you? Is it all clear how I come up with an option exit premium price? Okay, Gina asked to write it down. Okay, so let's have a look. So we know that the price change $2.25. We know that for each dollar, the option premium changes for 70 cents. So we take $2.25 multiplied by 0.7. How much is that? 2.25 multiplied by 0.7. $1.575. Okay. We understand that. That's the difference between current option premium and the future option premium. So then we need to add, how much did we pay for this? We paid $3.40 option premium now. So we add $3.40, and then we need to deduct the bid. And the bid, because we're going to sell it at a lower price, 20 cents lower, okay? And then minus 20, sorry. And that's how we come up to this number, okay? So it's $4, how much is there? $4.77.05. $4, my goodness, 47.5. All right. Now, Gina, you get it now? Perfect. So, and then see this difference. So it's actually profit going to be 157 minus 20 cents. That would be a profit, 137. So what you do, 137 divide by your investment $3.40, which gives you 40% return. So when you set in the orders, you can have straight away two orders, buy and sell, one trigger another. So you buy one and then you sell another one. So a similar calculation we do for another strike prices. So if you buy $20 strike price, so at the money you pay $2.40. We have delta 0.56. Okay, exactly the same calculation. So the only difference here, we do 225 multiplied by 0.56, the new delta. We get another number. We add the option premium we paid minus the spread. The spread here is 25 cents. Okay, and then that's how we calculate 4%. So if we go for $23 strike price, we pay only $1.30. Delta is 37 cents, and the profit is 52% on the same move of the share. Okay, guys, is it clear? Did you all understand how it's happening? Now, the important part of this specific strategy that you cannot put all your money into this trade, because if you're wrong and if the share price slides down to $15, if we bought just shares, we can keep them for another 2 years, right? And we can, then it will rise and we'll make money. Whereas if you bought calls, you have limited time, 1 year and 1 month, like in 2 months, okay, until 1 month. So if the share price doesn't move high on that level, you're going to lose 100% of money which you put in this trade. Okay, that's the risk which you're carrying with this specific trade. So be careful when you're buying options. So if you do it, what I usually do, I use the money which I got from other income. So for example, if I sold the call or I sold the put for the company, and I collected, for example, $1,000, I might put this $1,000 in this trade. So if I lose it, at least I don't lose my capital. I lose only the profit which I receive from that. Okay, and then if I make the money, I kind of nearly get extra 50% on the income, or sometimes you can double them. For example, with our investment club recently, we did the WBA trade, which was absolutely fantastic. We bought it, and we paid $3.70, I think, for the share, and put $7. This was one trade. We at the club meeting, we set at $3.70 and then sell it at $7. And that's it. 2 weeks, even not 2 weeks even passed. One day, one night, the stock price of WBA jumped up and the position was closed. So we made 80% profit on that trade. And now the share price on the way down. So we put an order to buy this call again. So sometimes you can make profit like that, but you have to understand that that's a risky strategy. Yeah, it is a nice one. Okay, so actually at the Russian club meeting we just had, one guy, he said he already bought this premium for $1.15 already. So he's already 15 cents ahead of us. But again, if you patiently wait until the share price drops to $90 as we wish, you actually can buy them cheaper. So this option, instead of $3.4, you will pay 70 cents less. So it would be $2.70. This is going to be 56 cents less. So it would be $1.90. And that's going to be 37 cents less. So it would be 95 cents here. If the share price drops to $19. Okay, so that's why use the same type of approach. When you buy shares, when you decide to buy shares, only then at the same time you buy options. Don't buy options at any time. Use same technical analysis. Okay.